Whereas Scott Arnell, Sustainable and Responsible Investing 360 Degrees. Lessons learned from world-class investors. Embark on a journey to explore the evolving world of sustainable and responsible investing, SRI, with Scott Arnell's book, Sustainable and Responsible Investing 360 Degrees. Lessons learned from world-class investors. Delve into the shift from socially conscious investing to proactive approaches that apply ESG metrics and drive change across all asset classes: public equities, fixed income, private equity, private debt, venture capital, and real assets. Witness how global trends, millennials' outlook, and investment priorities influence companies, institutions, and markets. Discover how investment strategies have evolved, along with growing transparency and standardization in reporting.
Investing for social and environmental impact. Investors are shifting towards socially responsible investment strategies that promote positive social and environmental change. This trend has led to the rise of acronyms like Socially Responsible Investing, SRI, and Environmental, Social, and Governance, ESG. Pension managers, in particular, are recognizing the importance of considering social and environmental impacts in their investment decisions. As beneficiaries become more vocal about these issues and concerns regarding climate change grow, pension managers are looking beyond just bottom-line returns to prioritize long-term, sustainable investments. This proactive approach to investing is in contrast to the earlier trend of socially conscious investing, which involved simply screening out companies with negative impacts. Now, investors are seeking firms that tackle difficult social and environmental challenges. By analyzing a company's metrics of social and environmental impact, investors can make more informed decisions that align with their values and promote a better future. This trend towards responsible investing shows that investors are recognizing the need to not only make a profit but also make a positive impact on the world. The business of sustainability. The world's growing population and unsustainable consumption habits present both challenges and opportunities for businesses. Companies like Beyond Meat show the potential for billion-dollar businesses that address societal and environmental challenges. Additionally, the millennial generation is demanding sustainable investing options, with more than half opting to go with counselors that align their investments with their personal values. Wealth managers will have to respond to these demands and incorporate social investing into their business models to remain relevant. The ripple effect of investment decisions. Each investment decision has a lasting impact on the world, and investors must consider the social and environmental implications of their choices. Traditional asset allocation strategies that only allocate a small portion of portfolios to socially responsible investments are becoming less viable. Investing in companies that disregard social responsibility only reinforces harmful practices. Institutional investors are beginning to demand social responsibility across all holdings. Investors can take advantage of socially responsible investment opportunities in all asset classes and prioritize different values within those classes. There is no one right way to invest in a socially responsible manner. After investing, the world is never the same. The rise of ESG investing. Socially responsible investing, SRI, has evolved from a simple screening process of companies based on social and environmental metrics to a more sophisticated analysis of overall practices and ESG issues. SRI has become a mainstream investing strategy as responsible companies have outperformed irresponsible ones. As investors demand more transparency, companies are now reporting more uniform disclosures that allow for SRI performance comparison. The Task Force for Climate-Related Financial Disclosures, TCFD, has introduced a reporting system for issuers of public equities, which is gaining momentum. In 2020, the United Kingdom made it mandatory for companies to issue TCFD reports on climate risk. The next decade is expected to bring a new wave of shareholder-driven accountability as investors seek out responsible and sustainable companies. Green bonds, an eco-friendly investment opportunity. The World Bank introduced green bonds in 2008, which are fixed-income instruments targeted at institutional investors who are keen on funding projects focused on sustainability. The green bond market has ballooned, reaching $270 billion in 2020 from $82 billion in 2016. Green bonds' similarity in structure to traditional bonds has made the transition easy for investors. Green bonds come with unique assurances for investors, with the funds being allocated solely for designated green projects. Issuers of public debt find them appealing because of the ability to borrow cheaply. Although, the creation and issuance of green bonds have met some setbacks, such as greenwashing, which confuses environmentally harmful investments with eco-friendly ones, episodes that have undermined investors' enthusiasm. Regardless, green bonds have enough traction such that more are being issued, and an increase in regulatory guidelines is evident. Private equity and sustainable investments. Private equity, PE, investments are different from public equity, where investors do attempt to influence companies' strategies and management. Activist investors find PE investments attractive because they can demand that companies follow sustainable strategies. Unlike public companies, PE investors are not restricted by financial performance benchmarks. ESG strategies are no longer exclusive to performance strategies. Impact funds have outperformed traditional funds according to a review of 450 funds in the Asia-Pacific region. The world's largest fund, Japan's $1.5 trillion government pension investment fund, mandates that all its investment managers sign the United Nations Principles for Responsible Investment. The fund has also directed at least 10% of its portfolio to sustainable and responsible investments. These moves show traditional approaches to investing are losing pace to sustainable and responsible investment strategies. Private debt deals for green projects. With growing demand for private debt deals from yield-hungry investors and companies looking for growth capital, the private debt market for green projects is thriving. Compared to private equity, private debt offers lower risk and more protections for investors in case of insolvency. Additionally, private debt enables investors to customize their investments by geography, risk profile, and project type. Private debt deals also give investors a more active role in the decision-making process, allowing them to select specific projects and negotiate terms. The market for private debt extends to various enterprises, from higher-risk emerging markets to lower-risk developed market assets such as airports, toll bridges, and real estate. Calvert Impact Capital, a non-profit lender, values the ability to tailor private debt deals to specific goals and has invested in affordable housing, black-owned businesses, and microfinance. Overall, the private debt market presents attractive opportunities for investors seeking to support green projects while reducing risk. Impact investing, the new norm in venture capital. Venture capitalists are increasingly investing in social impact, leading to a surge in impact tech deals from 2015 to 2020. This new breed of VC aims to tackle social and environmental issues, such as gender inequality and depletion of global fishing stocks. One example is Astia, a $100 million investment fund that removes gender bias and prejudice from its screening process and targets gender inequities by investing in women-led startups. Astia's approach of reading business plans instead of having the founder pitch them is proving successful in removing race, age, and gender bias. The term impact investing was coined in 2007, nearly 40 years after venture philanthropy was first used by John D. Rockefeller in 1969. Investing in real assets. Real assets, such as real estate and precious metals, can help mitigate risk and act as a hedge against inflation. Equilibrium Capital's greenhouses and 4 partnerships repurposing of an old office building are case studies for sustainable investing in real assets. Physical assets such as solar panels and forests also have a crucial role in reversing the damage caused by hard assets like oil and gas, which have contributed to the climate crisis. While hard assets have drawbacks, they offer high yields in times of low interest rates. Hard assets have a special place in the world of sustainable investing, where investors can make a difference by making socially responsible investments.
In conclusion, Scott Arnell provides valuable insights into the rapidly evolving landscape of sustainable and responsible investing. The book underlines the importance of acknowledging the long-term consequences of our investments, embracing environmental, social, and governance (ESG) approaches, and pushing for transparency and accountability across asset classes. As socially responsible investment continues to gain traction and attention from investors worldwide, it offers a path towards not only generating positive financial returns but also promoting positive change and a more responsible approach to navigating our shared human and planetary future.